The investor's chief problem, and even his worst enemy, is likely to be himself. The Intelligent Investor by Benjamin Graham is the foundational text of value investing and a cornerstone of Warren Buffett's philosophy. Rather than teaching how to beat the market quickly, the book focuses on long-term discipline, capital preservation, and rational decision-making. Graham clearly distinguishes investing from speculation. An investment operation is one that promises safety of principal and an adequate return after thorough analysis. Anything else is speculation. Mr. Market and emotional discipline. Graham personifies the stock market as Mr. Market, an emotional partner who offers to buy or sell shares every day at wildly varying prices. The intelligent investor does not follow Mr. Market's moods. He exploits them. Price matters only in relation to value. Defensive versus enterprising investors. Graham identifies two types of investors. Defensive investor, minimal effort, broad diversification, emphasis on quality and stability. Enterprising investor, active research, searching for undervalued securities, greater potential reward with greater responsibility. The right approach depends on temperament, not intelligence. Margin of safety. The central concept of the book is the margin of safety. By buying securities well below their intrinsic value, investors protect themselves against errors, bad luck, and unpredictable markets. Without a margin of safety, no investment is truly intelligent. Growth stocks with caution. Graham does not reject growth stocks outright. He warns, however, that high expectations often become fully priced in, turning growth into risk. Growth must be supported by value, not hope. Investing is a test of character. Ultimately, Graham argues that successful investing is less about intelligence and more about temperament. Patience, discipline, independence of thought, and emotional control matter more than complex analysis. The Intelligent Investor teaches a timeless lesson. To succeed in the market, you must first master yourself. Next, we'll explore how Graham's principles apply to modern markets, index investing, and long-term portfolio design.
All right, let's jump right in. Today, we're talking about a huge clash of titans in the investing world, the time-tested wisdom of a true legend versus the game-changing power of artificial intelligence. And we have to start with the man himself, Benjamin Graham. You see, this guy wasn't just some investor. He pretty much wrote the book on value investing. His ideas have been the guiding light for people like Warren Buffett for decades. So here's the big question we're tackling, right? In a world of AI, of companies that live in the cloud, do Graham's old school rules still hold up? Or is it time for a major update? Okay, so to really get this, we've got to go back to basics. Let's dig into what Graham was actually teaching. You have to know the foundation before you can see the cracks.
If you boil everything Graham ever said down to just one thing, this is it. This is the whole ballgame. He really believed these three little words were the secret sauce to being a smart investor.
So what on earth does that mean? Well, it's all about giving yourself a safety net. It's buying something for way less than you think it's actually worth. And that cushion, that's your protection. It means you don't need a crystal ball to predict the future, and it saves you when you mess up or just get unlucky.
And look, Graham drew a really sharp line in the sand here. He said there are two games you can play. There is investing, which is like running a business. It's based on cold hard analysis. And then there's speculating, which is just gambling. It's chasing hype, following the herd, and making decisions with your gut instead of your brain.
This is where it gets fun. He came up with this brilliant story about a guy called Mr. Market. Think of him as your business partner who is, well, completely bipolar. One day, he's on top of the world, offering to buy your shares for a crazy high price. The next, he's in a total panic, trying to sell you everything for pennies. Graham's point? Your job isn't to get swept up in his drama, it's to take advantage of it.
Okay, so fast forward to today, because this is where things start to get complicated. That brilliant, simple framework starts to wobble a bit when you try to apply it to modern tech companies.
Here's the core of the issue. The rule book we're using to value companies is just old. It was written for a world of factories and smokestacks. It knows how to count physical stuff, but it gets really confused by things like software, data, and brand recognition. Just look at this chart. It lays out the problem perfectly. If a car company builds a new factory, that's an asset on their books for years. But if a software company spends that same money on programmers to build their main product, well, accounting rules often see that as an expense, something that hurts your profit right now. It totally skews the numbers.
And that's why these tech stocks can look so crazy expensive to an old-school investor.
Their P/E ratios are through the roof, their book value is tiny, all the classic warning bells are ringing.
And you can see the problem, right? You've had these really smart, traditional investors sticking to the rules, and they just end up watching from the sidelines while companies like these go to the moon. They looked way too expensive on paper, but the paper was telling the wrong story.
So it really makes you wonder, doesn't it? Has the world changed so much that the old playbook is just broken? Is it time to throw it out?
All right, now let's throw the ultimate wrench in the works: artificial intelligence. This isn't just another new product. This is a technology that's completely rewriting the rules of how business works, period.
The potential here is just mind-boggling. We're talking about a $10 trillion market for labor software. Just think about that number. Experts are saying that even if AI makes us just 5% more productive, the value that creates is absolutely world-changing. I love this way of thinking about it. AI isn't just a tool. It's not just a faster spreadsheet. It's like having a super intern for every single employee. An intern that gets smarter every day, that you can copy and paste across your whole company, and that never gets tired. The productivity gains just compound.
And the crazy part? We're barely out of the starting gate. The experts think we're still in the super early stages. The road ahead sees AI becoming a daily tool, then doing things on its own, think self-driving cars, and eventually, it will literally change how we see and interact with the world around us.
So, what's the solution? Are the smartest folks in the room just tearing up Graham's book? Not at all. It's not about abandoning the principles. It's about evolving them for a new era.
It takes what some call second-level thinking. Anyone can look at a high P/E ratio and say, nope, too expensive. That's first-level thinking. The second-level thinker stops and asks, okay, why is the P/E high? Is something else going on here that the simple numbers aren't capturing? It's about digging deeper than everyone else.
And where do you start? You go right back to Graham's #1 rule. Think like a business owner. Don't just buy a stock ticker, buy a piece of an actual company. Understand what it does, who its customers are, and what makes it special.
But, and this is the key, you have to apply that thinking to a new set of numbers. Maybe you do have to ignore those cranky classic ratios. Instead, you focus on what really drives a modern tech business. Things like how fast are they adding users? How loyal are their customers? Does management have a clear vision for the future?
And once you start thinking this way, you see opportunities everywhere. It's that classic gold rush idea, right? You don't have to bet on the winning AI company. You can invest in the folks selling the picks and shovels, the chips that power AI, the people who install the systems, or maybe even overlooked AI companies in other parts of the world.
So, at the end of the day, value investing isn't dead, not by a long shot. That core idea, that margin of safety, is more important than ever. But how you find that safety margin has totally changed. The principles are timeless, but the tactics have to evolve. The game is different now. So the real question is, how are you going to play it?